Well, we just told you about the latest reading on the U.S. home prices. My next guest fears that housing prices have not bottomed yet and that it could be 2 more years before they turn around. Eugene Flood is president and CEO of Smith Breeden, which manages $8 billion, visiting us from North Carolina this morning. Thanks so much from a little bit further south. Yeah. Okay, Dr. Flood, thank you very much for being with us. And I do want to start on housing because we got these Case-Shiller numbers, and I know they lag a little bit. But they're still showing essentially that things are weak in the housing market. Getting a little bit better, but weak. And that is a scenario we're faced with for years, right?
That's right. At Smith Breeden, our forecast is that housing prices would fall from the peak to the trough using the FHFA numbers about 15%. So we are most of the way there. We are almost at the bottom. So that's kind of the good news. The more difficult news is that we're going to be here for a while. And so housing prices are going to bump around maybe a couple of months up, a couple of months down for about 2 years. The reason is that unoccupied homes for sale that are on the market right now,
vacant homes.
Vacant homes. There's about 2.6 million of those by our estimate, and that's about 30% above the normal average. Those typically are the sellers that are the most aggressive.
Right, because they're paying mortgages on houses that they're not making any money on.
That's right, and so they've got to sell. Okay. We think that it takes about 2 years for the economy to work through that. So we're going to bump along the bottom here for about 24 months and then begin to have a gradual increase in prices.
Now here's what I've been hearing from people like Mike McKee here, but also others, that even if the housing market bumps along for a little while, it doesn't matter as much anymore. The housing market's not that big of a factor in GDP anymore.
That's right. It has become a lot smaller. So we don't have to worry that it's going to be a big drag on the economy. However, it has always been and probably will continue to be for a while an important part of the consumer's balance sheet in terms of their assets. And so when that sector is in decent shape, not falling, but staying stable or increasing, that helps with the perception that wealth is in stable condition and then people are willing to spend.
So then if it's not housing that's going to, so housing is not the factor for a double-dip recession. What is it going to be? Jobs then?
What's going to push us into a double-dip recession?
Into a double-dip, exactly.
Well, if anything does, it could be a shock to the overall capital markets, so the stock market or the bond markets, that or another banking crisis could push us there. Or if jobs fail to accelerate here and actually decrease, then yes, we could go into a double-dip recession. But that's not our central call at Smith Breeden. We put about a 20% probability on that. We think that we're going to be in a slow growth mode, something like 2% real GDP growth.
Right, 20%, which, to some will focus on 20%, but really that means an 80% chance that we are not going to hit a double-dip recession. So, that's the positive side of that.